Hello, good morning, and very nice to have a chance to give you another quarterly update on the Embark Horizon funds. First of all, let's have a quick look at the strategic asset allocation that we're currently working to. This, as you will know, is the strategic asset allocation benchmark set by eValue based on their expectations of long-term risk and returns. And they are designed to give the optimum allocation for your clients. It's not related to peer group. It is the best for the funds. And this is the Q3 benchmark. So very shortly, around the month end, around the end of October, we will be getting a new strategic asset allocation for the rest of the year. So how do we see the world at the moment and how we position relative to that strategic asset allocation, i.e. what tactical positions are we taking at Columbia Threadneedle to add value for your clients? So first of all, if we look at the equity background and starting with how we see growth in the future, this slide just shows, to start with, that the authorities around the globe continue to push growth. And whether it's monetary policy on the left-hand side or fiscal policy on the right-hand side, the authorities are doing their best. Their feet are on the accelerator floor. On the left there, we've got quantitative easing around the globe, and you can see that that has been very spectacular in size. The authorities have put together massive quantitative easing programs, and they continue to be in place at the moment, much bigger than anything that was done in the global financial crisis. And they put those positions in place very early on in this pandemic. There's no doubt that we are talking now about tapering, i.e. cutting back on the extent of the quantitative easing, but I think it'll be a gradual wind down. It will be well advertised by central banks, so it shouldn't be a particular concern for markets. And at the same time, on monetary policy, interest rates have been down around zero in all the major economies. Again, as economies pick up, we will see interest rates rising again, but I do think that they won't be for a bit yet. And when they do come, they will be small and gradual increases. In a nutshell, we expect monetary policy to remain loose, or as we say, accommodative. On the right-hand side, as I said, fiscal policy, what governments are doing with their expenditure. This just shows that the size of the packages being put together, adding to public debt. And there are a number of very substantial fiscal packages being put together by the major economies. Obviously, Biden's big packages lead the way in that respect, and he is trying to push them through the politicians at the moment. But it's very different from the global financial crisis this time round. There's no talk of austerity. The authorities are really pushing to make sure that economies recover well from COVID. And the other thing about growth is that there are excess savings that have been accumulated during lockdowns. People haven't been able to go out and spend as they normally would. And so big savings have been built up in a number of major developed economies. So putting all that together, we are optimistic about growth. Recent economic indicators have been very encouraging. We are seeing a good V-shaped recovery. And, we're talking about some pretty impressive GDP numbers. Our forecasts are for just short of 6% GDP growth in the US this year, 2021, and around 4% next year, well in excess of what you would normally expect. In the UK, again, it's good growth we're looking at. We're looking at around 7% this year, and we think that'll come down to perhaps just a little bit over 4% for next year. So for equities, the economic background we believe is looking pretty good. On top of that, the earnings environment for companies, again, is encouraging, and that obviously is crucial for markets. And here we show, to start with, on the left-hand side, the growth in earnings for the US market. And we can see there that over the year, to the last reporting season in the US, the S&P earnings have gone up by 89%. That's a fantastic recovery in corporate earnings. Secondly, if we look at the number of companies, or the percentage of companies beating analyst expectations in the last reporting round, it was 87% of companies came in ahead of analyst expectations. That's a very high percentage. And they weren't just beating expectations, it was a comfortable margin. If we look at the bar at the bottom on the left-hand side, you can see that companies were beating analyst forecasts by around 15%. That's a very wide margin. So US companies doing very well. And it's not just the US, it's elsewhere. We mentioned Asia on the right-hand side there. But it's the same whether you look at Europe or Japan. Companies are reporting good figures. And with that, they're reporting good dividend increases or restorations, where companies have completely passed dividends during the pandemic. They are now being restored. So that's very good for investors who are looking for the income. And it's good for markets in that some of that money will get reinvested again, so as to demand for equities. So all in all, given a good economic background, given a good corporate profit background, equities remain our preferred asset. It has to be said, they aren't cheap at the moment. It has been a fantastic recovery. So although we're above the E-value benchmark in equities, we aren't to a huge extent. And we have reduced to some extent the amount of that overweight, but still overweight, still preferred asset class. But it is expensive, and there are risks. There are risks of another COVID flare up. There are risks that interest rates may rise faster than we anticipate at the moment if inflation becomes more sticky. But at the moment, we are optimistic on that front too. But that's something I'll talk a little bit more about later on. So moving on, while still on equities, just to mention equity style, because again, that's something that's been spoken about a lot, and there has been a huge divergence in the type of company that's performed well and the type of company that's done less well. Throughout the pandemic, there's no doubt that growth has massively outperformed value. The light blue line on the left-hand chart has struggled, although more recently we have seen a reversal of that trend as growth became quite expensive and value looked like it needed a bit of a bounce, a bit of a rally. And we did anticipate that that was likely to happen. So we were very growth orientated throughout the pandemic. But towards the end of last year, earlier this year, we felt that a rally in value was more likely. So we did shift the portfolios to some extent in that direction. I mean, not a massive, complete wholesale move by any means. Our natural preference is for good quality, well-run companies that we think have real growth potential over the medium term. But every now and again, if you think that value is going to have a rally, cyclical type stocks, we like to shift the dial a bit more in that direction to reduce the damage to the funds. So we added to more cyclical markets like Japan, like the UK. We added to equity income funds as opposed to more growth orientated funds, because they are more value type funds. And the portfolio managers in their funds, i.e. the UK funds, the US funds, they added to more cyclical stocks, for example, In the US, the fund managers there added to railroads, they added to building companies. In Japan, the fund manager added to recruitment. In emerging markets, we added to retail, etc. But having said that, we still, over the medium term, prefer the outlook for growth. And it's partly because it is still a tough world. I mean, I said the economies are recovering fast, but it is still a very competitive, difficult world. And so you do need strong companies. But also, there were a lot of important trends, changes in consumer ways of doing things that were important before COVID, and COVID has reinforced those trends. Things like online shopping, etc., which we show in the graph there. And those very entrenched positions now, entrenched changes, you need to be in the companies that are benefiting from that rather than companies with yesterday's business models. So, as I said, we shifted the dial a bit about 6 months back. Now we definitely think it's right to focus more on the quality companies again that we really like and really believe in. So that's equity style. If we move on to fixed income now, the background for fixed income remains perfectly healthy. As I've said, we expect interest rates to remain low, which is obviously good for bonds. Quantitative easing continues for now, which again helps bonds. We think inflation will remain low, so again that's a positive. But having said all that, value is just limited. And you can see from the yields there shown on the left-hand side, they are very low compared to the last 20 odd years. And that we struggle to see value for the medium term in those yields, although they have clearly gone up in the recent past. In the US, the 10-year treasury is up to sort of 1.6. The 10-year gilt's gone through 1% now, which is better than it was a few weeks ago, but still we struggle to see real value in that. So less enthusiastic about bonds. But within bonds, what do we see that's interesting? When it comes to government bonds, we think that the US market is one of the more attractive. As I said, it yields a lot more than the UK does. It yields an awful lot more than Germany does, where you only get a yield on the 10-year of minus 0.2. So guaranteed to lose money over 10 years if you hold one to maturity. That really is bad value. So the US, we like within bonds, and European periphery, the likes of Italy, we think looks quite attractive to, again, relative to the core, the likes of Germany. And within the whole bond market, we think that credit, i.e. corporate bonds, are more attractive than government bonds. Although spreads have come in a long way, and we can see that on the next slide. They really, that excess yield has come right back down to much lower levels, but we still think that gives you, as we say, a useful carry, i.e. it is a higher yield than you're getting on government bonds. It's a bit short of 1% more you're getting annually on investment grade, and about 3% more you're getting on high yield. And we think that is worth having. The risks are, fully paid for, we think, in that spread. So that is our preference. And within credit, we think that high yield looks more attractive than investment grade at the moment, although we do quite like both. High yield at the moment is seeing a low failure rate, and where we are seeing failures, there's a good recovery rate. And there's generally less duration, less gearing to government bonds in high yield. So in recent months, we've added a new holding in the funds in high yield bonds. So that covers how we see investment grade and high yield and government bonds. So moving on, I said I'd just mention inflation because it is very much a topic at the moment. We think that inflation isn't a medium-term problem. No doubt, short-term, we are seeing a spike in inflation. But we think that the reasons for that are due to bottlenecks, dislocations, problems arising from the pandemic. And we don't see why over the medium term, we should have the supply constraints that we're suffering from at the moment. And if we look at inflation, it is quite localized. It's in a number of areas that have really been hit hard rather than a general issue. And the areas we've seen, I mean, second-hand car prices have seen a massive increase. They're up by about 10% in the US, about 15% in the UK, which is a massive rise. And why is that? Why should it be second-hand cars? It is because people are buying cars now because they don't want to go on crowded public transport to work. They'd rather be in the safety of their own cars. And there's a supply shortage. Because there's a shortage of chips coming out of the US, coming out of Asia, rather, sorry, from Asia, there aren't the same number of new cars coming onto the market. And also we are seeing, because of the pandemic, banks were asked not to foreclose on loans on cars. They were asked to be more understanding while consumers got through the pandemic, and therefore we haven't seen that flood of cars coming onto the second-hand market that we normally do from people who can't carry on paying the interest charge on the debt on their cars. So a shortage of supply caused this real spike in second-hand car prices. Airline tickets, likewise, we've seen a big increase in prices compared to where we were a year ago when there was virtually no travel. In the UK, the shortage of truck drivers is a real problem. But again, that's a specific issue due to Brexit. We're not getting Eastern Europeans coming over in the same way. And there wasn't the training for new truck drivers in the lockdowns. The gas price recently has become a major issue, obviously, but again, that's a sort of perfect storm that's come along, partly due to the weather. We've moved towards greener energy, and we have just gone through a period of very little sun and very little wind. So sustainable energy hasn't been produced at the normal rate. At the same time, there were maintenance issues on the pipeline in the North Sea and so on. And the Russians, who now produce an awful lot of our gas in the UK, couldn't resist the opportunity of reducing supply just to show how important they are on the globe. And that has caused this spike. So in a nutshell, we don't think that the current shortages, the current issues around inflation are medium-term problems. They should all be sorted out. And therefore, we think inflation will remain or return rather to more normal levels. And if we look at the graph on the right-hand side, you can see that inflation over the last 20 years have generally been in the range of about 1 to 2.5%. We think it will return to that sort of a level. And at the same time, as well as these bottlenecks being sorted out, there are in fact a huge number of productivity gains that should come through in the near future, which will again free up resources and reduce some of those inflationary pressures on things like wages, things like automatic supermarket checkouts, which the technology is there. Amazon have got 9 supermarkets in London now without human checkouts. The Co-op are now experimenting with automatic deliveries to your house. They call it robot deliveries, a thing that looks half like a supermarket trolley and half like a pram, delivers to your doorstep. These things are drone delivery. The Isle of Wight are using drone delivery at the moment for chemotherapy treatment because of the truck driver shortage. So again, this is reducing the need for people. So we think inflation, as I said, is not going to be a medium to long-term issue. Moving on to the summary of how we see things, that is our overall asset allocation position. You can see there the top line, the major asset classes, overweight equities. And I've talked about the background there. We dislike government bonds. And again, I've talked about that. Not a bad background, but a lack of value. Again, coming back to favour, we like credit relative to those government bonds. Moving on to the second line there, the middle section, which we go back just to the previous slide to show the geographical preferences we have. You can see in the favour column, our favoured markets are Asia, Japan, and the US. In a nutshell, the US is a very robust economy. It's one of the best in the globe at the moment. And there we see an awful lot of those sorts of companies we like, the global leaders in tomorrow's technology. Japan, I mentioned earlier on in passing that we've added, because it is a more cyclical market, very much geared to global trade. And therefore we like that for that reason. But also there's a lot of change taking place in Japan towards running companies in a more westernized way, i.e. maximizing profits, greater efficiency, which obviously adds to the attraction of the market. Asia is an area where we see great medium-term potential. Again, there's some big global leaders coming out of Asia. A lot of them, I mentioned chip manufacturing, companies like Samsung, and Chinese-orientated companies supplying that massive growth of consumer wealth in China. So we do like that market. It is favour, but we did reduce it from strongly favour quite recently. And the reason for that is because the authorities in China are taking a more active role in spreading wealth more widely at the moment. And that does mean they are putting in place measures that are reducing some of the attraction of companies in China aiming at the more upmarket customer base, which has had a negative effect on share prices. And they're trying to spread the wealth more widely within the economy. Medium term, they know that they need to have a thriving overall private sector. It pays an awful lot of the tax in that country. It is accounting for an awful lot of employment in that country. So they don't want to hit their corporate sector too hard. So we do still have it as a favour. But in the short term, given this uncertainty about this new policy, we've reduced the extent of the overweight there. The neutral column has the rest of the equity markets. And as I said, we increased the UK quite recently up to neutral from underweight. And that was because, again, the UK is now a very cyclical market. It's a very service-orientated market, and services were the area that really got clobbered in the COVID period. Secondly, the UK has underperformed the rest of the world by quite a long way, and so there is definitely value there in the UK market. So going back to the next slide, that just shows us the positions we have relative to that strategic asset allocation benchmark set by E-value, i.e. these are the tactical positions we're taking at Columbia Threadneedle to add value. And you can see in line with what I've been talking about, the dark green boxes on the left-hand side show us underweight bonds overall, but within that we are overweight investment grade and particularly high yield. The middle section, equities, we're overweight equities overall, particularly focusing on the US, Japan, and emerging markets, which is where we get our Asian exposure from. One slide we've put in is on the next page is covering ESG, which obviously is such an important factor at the moment, something clients are really looking for, and it's something we strongly believe in at Columbia Threadneedle. It's very much aligned to our overall investment policy. As I've said, we like to focus on good quality, well-run companies, and companies that are good on the ESG, the sustainability front, are also the well-run companies, the companies with the lowest risk. So it's entirely in line with what we're looking for anyway. We have extensive research here into ESG. We give proprietary ESG scores to over 8,000 companies. We don't believe in banning any sectors. We just want to support the companies that are moving in the right direction. We know we're going to carry on using oil, etc., for some time, but within that sector, we want to back the companies that are moving towards sustainability, extracting oil in the cleanest way, etc. And we also engage with companies a lot. And one such company, the example here, is Volkswagen, which is obviously a company that was in a very bad place post the emissions scandal quite a few years back. But now they have got a completely new management team, a completely new approach. They've really cleaned up their act, and they are now the leaders in electronic vehicles. So quite a change, and the sort of company we want to support. The companies that are putting their best foot forward and leading the way. Finally, looking at performance, on the next slide, we can see on the left-hand side of that chart, performance over the longer term since we've been running these funds, and the performance over that period has been strong. We've been adding value, and eValue have set some good benchmarks. So good performance over the longer term. Over the shorter term, it has been a little less good. And as we've said before, the major factor there is that the benchmarks that eValue set are designed to be the optimum benchmark for risk and return. They're not designed relative to the peer groups that these performance figures are measured against. And some of the funds have a lower equity exposure as a result compared to the peers. And therefore, in periods of very strong equity markets, these funds lag the peers, but these, we think, are very good benchmarks for the long term for your clients. So in summary, on the final slide, these Embark Horizon of funds, they are risk-targeted funds, and they benefit from insight added value at 3 levels. We've got Embark, the ACD, looking at the correct management of the fund. We've got eValue, with their extensive modeling, looking at their forecast for risk and return, providing strategic asset allocation, and us at Columbia Threadneedle adding the tactical asset allocation around those benchmarks, looking to add value through asset allocation and by investing in our in-house funds through stock selection as well. The funds are all invested in Columbia Threadneedle funds, which has the benefit that I really know what's in those funds. I can get under the external core of those funds to see what's going on. It helps keep costs down. It ensures effective governance and ensures that we're getting the right ESG analysis going on in the funds. And that package overall has led to good long-term outperformance. I will leave it there for this quarter. Many thanks for listening, and I will be back in a few months' time. Goodbye.